Hey guys, what's going on? This is Kyle at Projection Hub, and today we talking about what are the 5 C's of credit when it comes to getting a small business loan or getting an SBA loan. Now, you may have heard of the concept of the 5 C's of credit, and it's just kind of like a mnemonic device that many lenders will talk about that really represent 5 kind of key categories that a lender is going to review or check to make sure that you as an applicant and your business kind of check off all of the boxes for them to feel comfortable with making a loan. So they want to make sure that all 5 of these areas are, supported whenever they're approving a loan. And so in today's video, I'm going to be kind of going through what the 5 C's are, but also giving you examples of how you can kind of overcome those or prepare to meet the expectations for those 5 C's. And I'll demonstrate some things you can do in your business plan, in your projections, and kind of just preparing for that application process to make sure you don't run into any roadblocks there. And then, as I mentioned, my name is Kyle, and before my time with Projection Hub, I was an SBA loan officer for about 7 years. And so during my time doing that, I got the chance to work with, hundreds of different startups and small businesses by helping them prepare a loan application, review their business plan, review their projections, take them through the SBA loan process, help underwrite their loan, approve and decline different loans. And so the stuff we're talking about right now, or we're going to be talking about, is something that I did for almost 7 years with real life small businesses trying to get an SBA loan. So if at any point you like this video, give it a thumbs up. That really helps us as a fellow small business. Also consider subscribing to the channel. But also if you have any questions about your business or your SBA loan application, drop us a line. You can comment down below the video. We answer there, but you can also just contact us directly at support@projectionhub.com or live chat on our website. We would love to help you. So without further ado, let's go ahead and jump in. All right, so here we go. As you can see on one side of the screen, I kind of have our guide, right? So right there, you can see the 5 C's of credit, our character, capacity, capital, collateral, and conditions. There's no reason to hide those 5 things. You maybe even have heard of them before, but hopefully the main takeaway from this video is just to dissect those a little bit. So explain what a lender is going to be looking for and what are some tools or ways to prepare for it or to demonstrate a satisfactory thing for each one of those kind of conditions. And on the other side of the screen, right now you can see I've got our free daycare business plan template up. So I'll use some different tools and some different things to demonstrate some of those items over here on the other side. So we'll kind of be bouncing back and forth and opening some different things. But as I should have mentioned, because I think I talked about in the introduction, my former experience as an SBA loan officer, but I didn't really talk about what Projection Hub does. So our sweet spot is creating, or our specialty is creating financial projections for startups, small businesses that are trying to apply for SBA loans or raise investment or, do anything really that would require some sort of business planning or projections. We also help with business plans. We also help with SBA reviews and just a whole lot of things, but our specialty expertise is in the financial projection side of things. So we've helped more than 50,000 small businesses create financial projections for many of the things I just listed. And so we've seen a lot of business plans. We've seen a lot of projections, both in our former experience as SBA lenders and our current experience with Projection Hub. And so that's kind of the lens I'm going to be talking about this today. So yeah, let's go ahead and start going through this. So first up, we've got character. Now you can see, these examples or things that might make up the character test. It's just to give you an idea of like what they're looking for in character. They're trying to just get a sense of like how reliable you are as a borrower. What is your general trustworthiness? They're not trying to decide like, are you a good person or a bad person? That's not the test they're doing here. It's just more or less your ability to repay something and just your level of trustworthiness in general. So you can see some ways they're going to check that. Most important one, most common one is going to be a credit check, a credit report, right? That's why, credit is so important when it comes to getting a loan, is because that's really the most universal kind of grade or rating when it comes to a person to get a sense of like across their whole life in general, like how committed are they or disciplined are they to trying to maintain a solid credit score. A not stellar credit score is not the end all be all. It's obviously makes it easier if you have a high credit score. If you're in the mid-high 700s, right? That looks really great. But if you have a 600 credit score, or, I guess the thing is just be prepared to, when it comes to the credit report, if that's going to be a concern for you, be prepared to tell the story, the true story. If you've went through some sort of medical thing and you've been working through that and trying to repay it, but that was several years ago and you're just trying to, kind of come back from that, like be prepared to tell that story and make sure that lines up with what your credit report actually shows, and make sure you're doing the things you can there. Like if there's things that are on there that shouldn't be anymore, dispute those things, request them to be removed. Like it does take a little bit of work, but that's one of the things they're going to check. In regards to especially like a startup or an acquisition, the lender is going to want to understand, like, what is your experience? Like, do you have relevant or applicable experience in the industry, or, managing a business, starting a business, knowing how to take care of that business in general. And so, they're just going to want to see some proof there that you know what you're doing, you know what you're getting yourself into. And one additional example here was references and testimonials. When I was a lender, occasionally we would get references and testimonials. That's not something we required, but occasionally sometimes we would get, someone did something for a long time. They're like, hey, I've got friends in the industry that want to be customers, and here's a letter from them saying that they would gladly use our support, our service or company once we get up and running. And that was helpful, but that was not a requirement. We weren't making phone calls and checking references for a borrower. We were relying more on these first two, right? Their personal credit and then their general level of experience when it kind of came into it. So you can see some basic preparation tips here, but the one thing I really want to focus more on is what I've got highlighted in the yellow for each section. And that is, how do we demonstrate this? So I already talked a little bit about the personal credit report. I'm not going to show you anything on how to do that because, that's not my forte. But just know, like, if your personal credit is a concern, be prepared to tell that story truthfully and demonstrate what you're doing to clean that up. And hopefully that suffices for them. And we'll talk, about other ways to help get around that. There's one thing that kind of spans across this C and another one later on would be something like a cosigner can be helpful to get around any personal credit concerns or character concerns. If you can use someone else that has a really strong character or credit rating. But when it comes to business experience, because I think that's probably the biggest one you have control over when putting together like your business plan, and that is demonstrating very clearly that you and your circle around you know what you're doing and you really know what you're getting yourself into. And so I did this little, kind of not flow chart, but this hierarchy here of explaining that, right? So first, the most important thing for you, the owner, talk about what experience or transferable or applicable relevant skills you have for, let's say, starting a daycare, right? So you want to talk about that, right? Maybe you've never owned or managed a daycare before, but maybe you've been a marketing executive, right? And you recognize an opportunity. And so what skills you might have are maybe managing people, maybe managing a budget, sales, getting leads, getting people. So there's important skills there, and you want to talk about those things, but clearly you're missing some relevant skills there, right? The actual act of managing the logistics of a daycare, certifications of taking care of children, like there's things there that are missing. And so we need to demonstrate that we are supplementing our experience. So the next step of that would be, are you going to have a partner in the business that brings that missing skill set? And you can see here in this free daycare business template, which I'll link down in the description below. We've got, closing in on probably 100 different industries of free business plan templates that you can grab your own copy for. You can use it as a guide writing your own business plan if that aligns well with your stage. But this is a really simple business plan example here, and this isn't anything groundbreaking. But the fact that it's in here is important. I would even encourage this person to write more about this, and certainly be sure to talk about it with your loan officer. But we can see here between these two owners, Sarah has a bachelor's degree in early childhood education, has worked in the daycare industry for over 10 years, and Maria has a background in business and an experience managing a successful small business. So those are pretty two compelling, between those two partners, that should give a lot of confidence. Now, there's probably more information we would want there than that, but that's a good example of how they're complementing each other's abilities there, right? So if you're not going to have a partner, if you're going to be a solo owner, the next best thing would be a key manager. So let's assume your ownership, again, you're the marketing executive, so you have some important skill sets, but you're still missing that key component of managing a daycare, running a daycare before. And so maybe you have a friend or know someone in the industry that has the 10 years of experience of managing and running a daycare as the, lead manager or something like that. And if you've already got them locked in and they're like, yes, I want to join your daycare, talk about them. Next step down would be, are there any other key staff members? Maybe you have a friend who's been a teacher in a specific classroom for a long time. Like, okay, that would be helpful. And then beyond that would be like advisors or mentors that have relevant experience and can be guiding you. So you can have all of those things, but yeah, supplementing whatever you have to give your lenders the confidence that they're going to be okay. As a team, they've got all the pieces of, at the table. They're going to be okay. So that is character. That's the first C. All right, let's keep moving along here. Now we have capacity. So we're referring to the ability to actually, can the business actually pay for the loan? And so this is where the lender's really going to dig into all of the financial details that you're providing, the financial projections. You'll see here a debt service coverage ratio. So a lender is going to, they're basically going to, that's a calculation they're going to do based on your projections, that you are going to generate enough cash flow once they figure in their loan repayment that the business projects, realistically to generate enough free cash flow to not only survive, sustain, be profitable, but also repay back the loan on top of that. And so one would be barely enough. So 1.25 is a little bit of a cushion. So different lenders have a different number they shoot for. Might be 1.15, 1.25, 1.35, depending upon, the economy and the industry and the lender. They just are going to have a different number they're targeting there. But so the main thing I'm going to talk about here is just your financial projections and some key points. So our highlighted tip here is you need to have, especially if you're a startup, you need to have financial projections. That's really a non-negotiable. The key point here is to make sure that your financial projections are realistic, that they're believable, and that they're within kind of industry expectations. So you're not way too optimistic or overly conservative. You kind of want to find that sweet spot. And so what I'm going to bring up right here, and if I scroll down in this business plan, you can see, it's got some examples, and those were all created, just to give you an example, using, opened on the wrong screen, bad production value there. But those were all, those projections in that little business plan were used creating this template. And I'm going to use this as an example for you. If you need to create projections, we've got, let me show you really quick. Just like with the free business plans, these ones are not free, however. Again, projections are kind of our specialty. This one, we've got well over 100 industries of templates that you can create your own financial projections. Everyone comes with a video guide. Everyone comes with free support from our team, free review of completed projections, and we also offer a 100% money back guarantee if we cannot get the template to work for you. So that might be worth checking into. But here I've got the daycare projection template to continue on with our example. And so you can see in these blue tabs, this is where we're inputting our information. And we're only inputting information in these blue boxes. So it's all pre-filled out with kind of an example use case to help you fill it out. You'll put in, some of the basic assumptions you need to know for your daycare, the loan you're expecting to have, the assets, the big assets you're planning on purchasing, if you're going to have any, investors. This revenue tab is pretty cool. It's basically helps you map out how many rooms are you planning to have, the capacity of those rooms, your teacher to student ratio, how those kids will pay, so the important things for a daycare. And then these numbers down here, again, we're only touching these blue boxes. It's performing the revenue calculation here. It's going to trickle all the way down, calculate the revenue. And then this tab, you'll put in your recurring monthly expenses, and then salary, any salaried employees and owner dividends would be here. And then it's going to create all of these projections. So these are 5-year financial statements kind of annualized there. So we've got our income statement, cash flow summary, and balance sheet. And then you also get the monthly breakdown of 5 years of each of those statements. So my purpose in showing you this was, you have to have financial projections. Whether you use a tool like this, whether you hire an accountant, whether you hire us to create your projections for you, there's a lot of options out there to do that. But once you have your projections, or let's say you used a template, you use this template to create it, you need to benchmark those templates. Okay, so it's one thing to have projections, it's another thing to make sure that those projections are realistic and within industry norms. And you might be wondering, like, well, how do I do that? And it's kind of a frustratingly easy answer, and that is just to Google it. Or if you're comfortable using a tool like a ChatGPT or something like that, it can be a helpful resource. So you can see all of these numbers in here are key numbers that we can kind of look up benchmarks for, right? So let's look at net income, or your profit margin. That would be your net income, right? Your profitability. And so let's look up that, right? So minimize this, and I've got ChatGPT give me a list of typical financial benchmarks and averages for a daycare center. And let's see some of the stuff it talks about in here. So typical profit margin is 5 to 10%. Let's go back over to our completed projections, and look at that. We're pretty high. We're probably overly optimistic. So if you're going to be optimistic or outside of something like that, you got to kind of be prepared to explain that, right? Like, what makes our daycare more profitable than what would be typical for the industry? What's our secret sauce that's going to make that happen? Or that's just a good example of, we need to dial it back in. So my recommendation is complete the projections to the best of your ability, and then kind of work backwards, right? So if we realize, like, wow, we're gonna be too profitable, go back through and look, like, did we miss an expense that we're not thinking of in here? Are we not paying our teachers enough? Are we charging more than is normal for students? Like, that's what I would mean by benchmarking. So once you kind of have that dialed in, then when you're handing over your projections that those are based in reality, you're making a good first impression. Your lender's not going to, whoa, they clearly don't know what they're talking about, because they're way overestimating what they think they can make. And so that's going to dial in your cash flow statements when you're doing the projections. And if your projections are realistic and you kind of have that dialed in, your debt service coverage ratio should be where it needs to be too, because that projection template even is going to be taking into consideration your loans that you're planning to get. So that's number 2, is capacity to repay the loan. Best way to do that is to really have dialed in and outlining your financial projections. And that's the way I would do that. I put a link to this down in the description below if you want to try to find your industry. There's also a link down there to get a promo code to get a discount in any one of the templates. So please feel free to enjoy that. And if you have trouble picking out what template you need, you can fill out this little request form, but also just ask us. You can reach out at support@projectionhub.com, and we'd be happy to help you pick the right template for you. All right, moving along to capital. So capital is referring to how much money have you as the owner, like, what's your skin in the game? What are you putting into the pot here, right? So this says it indicates the owner's commitment and financial stability of the business. So again, I'm going to be talking about this more through the perspective of, let's say you're a startup looking for an SBA loan. If it's going to cost $100,000 to start up your daycare center, your lender's not going to give you $100,000, right? There is going to be, I think I've got it highlighted down here, SBA loans are going to require at least a 10% owner investment. So, if you need $100,000 to get started, you're going to be required to put in at least $10,000 of that, cash contributed to that. Now, the SBA can be a little flexible on how you get that $10,000. Like, if you borrow that from your parents, that can still be your owner investment. The SBA's consideration is just going to be, though, that your parents have to get paid back after the SBA does, is, how something like that's going to work. An investment can work as well. If someone's investing that money, that can count as your contribution. But just know there's going to be a requirement. So there's a difference between what the SBA requires and what's going to make your lender feel good. So even if, someone gives you the money, technically that meets that 10% threshold, that may not necessarily give your lender the warm and fuzzies on, like, how committed you are, right? Your lender kind of like they want to know that you have something to lose, because that's going to make you more committed to making this work and paying the loan back. So you got to think about, that's what your lender's kind of looking at when they're doing this test for capital, is they want to see that you're meeting these kind of owner investment requirements, that the lender's not the one just risking all of their money, that you're risking something too. But yeah, it's just also kind of just a test of your commitment there. So, any investment can count towards that, but I don't have a great example to demonstrate for that other than you're going to have to come up with some cash there. So be prepared, knowing going into that that's the case. And some of those costs can be retroactive. So maybe you're already down the path of I wouldn't recommend securing a lease before you've gotten your loan, but let's say you've already spent money. You can count that retroactively. So if it's a $100,000 project and you're really committed to it and you've already spent, $5,000 getting mock-ups of the space created, and you've already started acquiring equipment for the classrooms and you have those in storage, like you can count that towards that. So it's kind of like a total project cost is what that percentage is gonna be looking like. All right, moving along to collateral. Everyone's favorite thing to talk about is collateral, especially lenders love to talk about collateral. So you probably know what collateral means, but that's really just like what's securing the loan, what's mitigating the risk for the lender. So if you buy a house, let's say it's a $100,000 house, we know those don't exist anymore, but the bank gives you the mortgage for that. You contribute a deposit or a down payment, so it lowers your loan a little bit, but the bank is holding the deed to that house, basically, right? So if you default on your mortgage, the bank gets that house, the bank resells the house, auctions the house, and then they use that money to make themselves whole, right? Pay down the loan, pay off the loan. And so that's offsetting their risk. The same exact concept for the business, right? So depending upon your type of business, your type of industry, you're going to have varying levels of collateral innately available for the business. Like a business like a daycare, not really going to be any collateral unless we're buying the building with a loan, right? So if we're buying the building that the whole daycare is going to be in, that's mostly going to be what our collateral is. If you are in an equipment heavy or real estate kind of heavy industry, that's probably going to be what your collateral is going to be. But if you have a collateral shortfall, then the lenders are going to want to see, they're going to want to explore personal collateral as an option. And so, I've got some bonus tips down here. And one thing, actually, let me talk about this first. And that is, if you're the owner, let's say you're a 100% owner or any owner greater than 20% or greater, you will be required to personally guarantee the loan. Now, I know the guarantee isn't technically collateral, but it's kind of the same bucket, and I want to make sure you are aware that this is going to happen. When I was a lender, all the time people would say that they had received the advice to keep like business and personal separate. And so they only wanted the loan to be in the business's name, not the person's name. That's a really great advice when it comes to accounting and bank accounts and bookkeeping, but that's not real life when it comes to guaranteeing the loan. You will be required to personally guarantee the loan, which means if the business fails to pay back the loan, you will be required to pay back the loan personally. You're going to be on the hook for that. And any owner at or greater than 20% or any co-signers in that same bucket too. And so just a little dose of reality that's something you should be prepared for. Secondly, I was already talking about how SBA lenders are required to secure as much collateral as possible. The SBA, the federal government, is requiring them to get as much collateral as possible because they're using tax dollars to help cover some of the losses for those defaulted loans. So things that work for collateral, I already mentioned buildings. If you have a free and clear car title, you could use that. You could pledge that as collateral for the loan. If you own a personal residence, a second mortgage on your house can be used. Now, obviously, these are uncomfortable things and nobody really wants to do those things. And so, tread lightly and know beforehand what you're willing to pledge and what you're not. And if that's going to be a deal breaker for the loan, just be prepared to, walk away from that. So yeah, if it's an industry or a business that's light on collateral, they're going to ask what's available personally. If you've given them everything you can, then they're going to have to ultimately make a decision if there's still a collateral shortfall, if they feel comfortable moving forward. Another thing that you can do, we already talked about it up in point one, but co-signers can also help meet the collateral kind of, test. So if you can get a co-signer who has strong credit and has strong outside income, so if they have like a good job that's obviously isolated from the business, that can help lenders get more comfortable when they're checking out this test, because at the end of the day, they're just trying to reduce their risk is really what your lender's trying to do. So large equipment is collateral, good collateral, real estate is collateral, but a warning, or I guess something to keep in mind is when I was a lender, sometimes people would submit like their personal financial statement or their application, and they would list all of the things they own, right? They would say $3,000 in clothes, $2,000 in household electronics, $4,000 in tools, all of those things, which to us as people, those things have value, but to a lender that they really don't, right? They, at the end of the day, like they would have to resell that. And so they're not going to do a garage sale outside of the bank, right? They're going to liquidate things in bulk, which means they're going to get pennies on the dollar, which means when they're valuing collateral, they're going to discount it. So the value to you, or the value that you paid, is not the value that the lender is going to assign to what things are worth, unless it's large equipment, real estate, vehicles, that kind of thing. Those hold value well. And so those will have a less of a discount percentage for a lender. So just keep that in mind. All the ticky-tacky, whether it's personal or business collateral, that's kind of the case. But every piece of equipment or every item in the business, if you're getting a loan, it's going to be pledged as collateral, right? And the lender will have kind of first dibs on that. So I probably talked ad nauseum about this one, but that's some tips about collateral and just being prepared for that conversation. And lastly, conditions. So conditions is kind of it's the catch-all for the things that don't fit in the other four buckets, I would say. This one is a little bit more fluid, right? It's like, what are the conditions of the market? What, like the market as a whole, like the economy, but also like the local market, right? Like, do we really need another bakery in this town that has 17 bakeries, right? Like it's going to change from place to place, situation to situation. This is also kind of like the general feeling of the lender. Like, does your business plan, your situation, like, does it just feel a little off? Like something's not fitting right? So, when a lender's reviewing your loan, they're not going to give you like this report card of the 5 C's and what you scored in each of them. It's more so just a general rule of thumb that they're kind of following when they're analyzing a loan, when underwriters are analyzing a loan. And so by you preparing for these, you're not going to say like, here's my 5 C's and what I check the boxes for all of them. It's more or less, if you can do all these things to make sure that when they talk about, or when they're thinking about these general areas, that you've kind of done all you can to make them feel good in each of these areas. And so conditions is going to be kind of a hard one because there's a lot of things outside of your control. Again, state of the economy, state of the local market. But what is in your control are some things here that we talked about. And we'll just jump straight to these bonus tips here. So your business plan, because that's the place where you're going to represent it best, should very clearly demonstrate, one, why your loan is needed, right? So if you're starting the business, probably going to be your startup costs, right? If you're growing a business, like what are you getting? Like, why are you growing the business? So why is the loan needed? 2, what will the loan be used for? Very specifically, what will the loan be used for? And then 3, how will that loan impact the ability to repay the loan? And so if it's for starting the business, if it's for growing the business, if it's for optimizing something so there's more, the business becomes more profitable, if you're buying something in bulk, and so that's going to give you more purchasing power, or some of that will go more to the bottom line. Any way we can tie the use of the loan back to the ability to repay the loan more easily, that is success, right? So that can be helpful to offset the risk of these macro things you can't control, is to very clearly define Why those things aren't as concerning, because here's why this loan is going to work, right? So that's how we cut through that is the more we can give confidence that the repayment of the loan is not going to be an issue, that helps meet this kind of conditions use case. So one quick example to give you here. So I mentioned we're starting a daycare center. And maybe one thing that we could do is demonstrate that there's demand in the market, in our local market, for a daycare, right? So one quick tool I like to use is you can create a free Google AdWords account. And they have this tool in here called a keyword planning tool. And this allows us to simulate how much are people searching for specific things on Google in a specific location. And so this free business plan template talks about opening a daycare center in Seattle, Washington. And so I've selected my location as Bellevue, Washington, which is kind of a smaller section of Seattle, because it would be kind of foolish to say, like, we're going to serve everyone in Seattle. Seattle's a really big city. So Bellevue is a smaller section. And then I said, I want to see how often are people searching things like daycare near me, childcare near me, early learning center near me. And then it's going to show us some really cool things here. It's going to show us how often, on average, per month are those things being searched. But what I care mostly about is this year-over-year change. So that's an indication of how much, in comparison to last year, how often is that being searched now, right? So if we're seeing positive growth here, 133%, 50%, 250%, 200%, that's an indication that at least the area, my target area, is seeing a growth in demand for the things that I want to show up for, the people I want to serve. Now, what this doesn't do is this doesn't demonstrate the supply side, right? So there's clearly a growing demand, a growing need for daycare centers in this area. But what this doesn't show is there might be 10 other daycare centers opening up, right? So you would need to do competitor research, talk about, have you done that check, right? So maybe we've established that there's clearly a need for more daycare centers, but maybe we've also done research to find out that there's really no other new daycare centers being opened, and all the existing ones have really long wait lists, right? So putting that together and putting that in our business plan helps offset the conditions for the loan. So if the purpose of the loan is very clear, we want to open up a daycare center. If it's, what are we going to use the loan for? All of the things we need to get our daycare opened up very specifically. And then third, how will the loan impact the ability to repay the loan? Well, if we can get our daycare open in a place that desperately needs more daycares, then we should have no problem getting kids and repaying back the loan, right? So you can kind of see the thought process there and kind of applying that to your specific situation. So that brings us to the end. One last thing I'll show you is kind of a bonus tip for conditions is sometimes it's about finding the right lender for your type of industry. Not every lender likes to loan to every type of business. So sometimes they have specialties. Sometimes they have certain portfolio, weights they're trying to balance. Sometimes they just don't, have a strong skill set in a specific type of loan. So a lot of times people they apply with their hometown bank first, or their local bank, which I highly recommend doing. But you shouldn't think just because you've been banking there a long time, you're going to get approved for a loan, right? You should have realistic expectations, because maybe your hometown bank doesn't have a lot of experience making loans to your type of business, especially if it's a startup. So I would encourage you to do some research to find a lender that might be a good fit for you. And we've got a couple of the videos that talk at more length about how to find a lender for you. But here's an example of a free tool that we have that you can get access to. I'll link it down in the description below. But we can search things like, we want to search for state of Washington. And this is basically using publicly available SBA data that we've organized so that we can filter to see who's making loans to specific types of businesses. So you can start to see each time I update these, the list starts to change. So we can see in the state of Washington for daycares, we can see who's making the most loans. Now, if I change this to new businesses, or let's do startup businesses, we can see the list changed, right? Now, these aren't huge numbers, but at least we know that these banks have had experience recently making a startup loan 2 daycares in the state of Washington. That's more applicable to me. Whereas if I would clear this, and I mean, even that's different, right? The 2 that were at the top are not even at the top anymore in general for startups. And then if I would take off even childcare, right, it's like the list is going to change. So using tools like that, we've got a free SBA loan checklist down in the description below too. I would recommend grabbing that and watching the video for that. That goes in much more greater detail about the SBA loan process as a whole and documents to prepare and all of that. But that's it for today's video. I just wanted to talk through, if you've heard of those 5 C's, in general, it's a good way to kind of approach preparing for a loan application holistically, and how your lender is going to be reviewing your loan through their perspective and the different checklists they're going to kind of be thinking through. And so these are some different tactics to better prepare for that and hopefully ease your way through the process of getting your SBA loan. So again, if you have any other questions, reach out to us at support@projectionhub.com, comment in the video below. And yeah, we would love to help you along your way with your SBA loan, whether it's financial projections, a business plan, or just getting some advice as it goes through the SBA loan process. We hope to chat with you soon. So like the video if you enjoyed it, subscribe to the channel. We'll see you on the next one. Thanks.